Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, money managers, traders, strategists, authors, educators, anyone that we think has a compelling story to tell. Talk to them about their approach, their tools, the techniques that they use to identify potential investments, how they manage risk, some of their lessons learned over their career. Kind of a different guest from many that we've had on the show. Today we're talking with Peter Krull. Peter's a founder and director of sustainable investing at Earth Equity Advisors, based in North Carolina. He's the author of the upcoming book, The Sustainable Investor. I actually met Pete years ago at an industry conference. We've kept in touch, and when I learned about his upcoming book, I reached out to him. He was very generous enough to share an advanced copy with me, which I absolutely enjoyed. I really appreciate how he described sustainable investing, the history of the space, looking forward. And I think what you'll find in our conversation, it was a lot about looking forward, right? So often when we think about ESG, environmental, social, and governance, it's about what a company has done or sort of a report card on what they've done to date. And his comment, our conversation was a lot more about forward looking, right? Looking forward to companies that are going to be at that, creating opportunities and growing businesses in sustainable ways. And that's really the essence of his forward-looking investment approach. We talked about that acronym SRI, which traditionally has been translated into socially responsible investing. Peter has his own way of translating those three letters into his approach. I'll let him describe what that is, but we talked about the challenges for investors of identifying companies that sort of check the boxes in terms of sustainability, how he tries to approach that, what sort of data is available for retail investors and financial advisors, what he and his team at Earth Equity Advisors does to try to identify companies and areas of the market showing those qualities of sustainability that are important to him and many of his own clients. Talked about greenwashing and how some of the data can be challenging because there's such a pressure at times for companies to appear more or less green friendly, and how the changing administrations, right, the governance of the company has impacted his and his team ability to evaluate companies more effectively. We talked about the current market environment, how some of the largest companies, a lot of the AI kind of technology growthy stocks, how they rate in traditional measures of ESG, and how you can relate some of these sustainability metrics to other asset classes like bonds, commodities, and elsewhere. If you're familiar with the sustainability or socially responsible investing or ESG space, hopefully this conversation helps to inform you about some of the ways that investors like Peter are trying to apply their their own values and the importance of sustainability in their own portfolio, how they're able to identify opportunities, how they manage risk, and where they see opportunities going forward. Found this a really great conversation. I hope you enjoy it as well. So please enjoy this conversation with Peter Krull from Earth Equity Advisors. I am super excited to be sitting down with Pete Krull. Pete is a founder and director of sustainable investing at Earth Equity Advisors, author of the upcoming book, The Sustainable Investor. Pete, it's awesome to see you again. You and I met years ago at a conference. I've been enjoying following your, sort of journey after that moment. And I'm super excited about your upcoming book. And thanks for sitting down with us today.
David, it's a pleasure to see you again. When you reached out, I was immediately excited because I know we really hit it off when we had some time or a chance to spend some time together. So let's do this.
So let's start off. Your book, the upcoming book coming out in November, is called The Sustainable Investor. And thanks again for sharing a copy. I really enjoyed reading it and would encourage others to pick it up as well. Let's start off just sort of defining this thing, right? Because even when you and I spoke years ago, there's a lot of acronyms thrown around. There's a lot of ways of describing this sort of idea of sustainable investing, SRI, ESG. Can you talk to me a little bit about what does SRI really stand for? What does that mean for you as you're managing, people's portfolios?
Yeah, absolutely. So The 800-pound gorilla in the room is the ESG, right?
Yeah.
That's the acronym that has gotten so much negative publicity, if you want to use that for a term. But
Yeah.
what ESG is it means environmental social governance, and it is a way to gauge risk at the end of the day. And so um, a lot of people in the media and politicians would have you believe that ESG is the risk that a company places on the world around it, on
Mm.
environmental risk or social or governance risk. But the reality is it's just the opposite. ESG is risk on the company. So, what is the environmental risk on a company of its operations? What is the social risk? What is the governance risk? And I like to use this example. So, let's say, for example, you have a manufacturing plant and that manufacturing plant is on the coast of Florida. Well,
Mm.
what happens on the coast of Florida? We have hurricanes. Is there a material environmental risk on that company's bottom line because they have a manufacturing plant for widgets or whatever they're making on the coast of Florida? Absolutely, there is. And so when you're doing due diligence, when you're looking at what are all the traditional financial metrics, this is just enhanced due diligence. Let's look and
Mm.
see what are these additional risks. Has a company in the past had issues, let's say, with HR, where they've been sued multiple times for issues dealing with gender or race or whatever it is. That is an environment, or that is a social risk on the company. It also can be translated into a governance risk as well. And so I give several examples in the book of different ways that ESG actually is a risk on the company. And
Mm.
so when you see an article that talks about how ESG is woke investing, the people who are writing it or the people who are talking about it don't really understand what it actually is when it comes down to actual due diligence. So so that's the first thing I would start out by talking about.
Yeah.
Um, but I typically will counter that or compare that to sustainable investing, which are two different things. And so what we've seen over the years is the big dogs, the Vanguards, the BlackRocks, companies like that, they have really sort of jumped on the bandwagon when it comes to ESG or sustainable investing because they equate the two. But ultimately, at the end of the day, what ESG investing is per se is these big companies will take an index, they will layer on top of it the ESG risks that I just talked about, and
Right.
they will present that as a sustainable portfolio. It's not a sustainable portfolio. It is a less bad, less risky portfolio because you have actually factored in some of those ESG risk metrics.
Mm.
Sustainable investing, on the other side, is more bottom up. So if ESG is top
Right.
down, sustainable investing is more bottom up. So how do we determine what are the companies that are going to be the leaders going forward into a next economy, a cleaner, more resource efficient, more resilient economy? And so it's a different process, and it takes some the ability to really understand where we're going, to understand what our risks are going forward. We talked a few moments before we started on the podcast here about I live in Asheville, North Carolina, and
Right.
in Asheville, North Carolina, 500 miles inland, we got hit with Hurricane Helene back. We're recording this in September of 2025. Almost a year ago, we got hit with a hurricane.
Yeah.
And one of the things that I really learned out of that is that we are not prepared for these storms. In Asheville, we had a failure of our utility infrastructure, we had a failure of our communication infrastructure, and we had a failure of our transportation infrastructure. And so that is obviously a risk, and that's something we need to really start addressing, but it's also an opportunity. And so
Mm.
the thing that I really learned going through that was that SRI, which is what when I started in this business 20 some years ago was socially responsible investing, really needs to evolve. It needs to evolve into something a little different, that where the S is sustainable. So we need to reduce our
Mm.
impact. We want to make it so that way future generations get to thrive just the way, David, you and I have been able to thrive. But the R needs to transition into resilient because we need to be more resilient in the face of a changed climate, which is what we're in right now. It's not climate change that's in the future. It is a changed climate that we're dealing with and we're living in right now. So how can we be more adaptive? How can we be more resilient in the face of that? And that really is a lot of infrastructure. And so infrastructure, I think, is ultimately going to be a key investment theme going forward. I don't even see, where an end might be to that. And then the I is innovation, because innovation allows us to become more sustainable, to reduce our impact, to be better with how we manage our resources. Innovation also will help us with the resilience side. How can we better manage sea level rise? How can we better manage fire areas and things like that? And so it's a really exciting story, even though
Yeah.
at the core of it, it's sort of depressing because of where we are. But when you think about the opportunities that we have to really make a difference and potentially invest in the next economy,
Yeah.
it's really exciting place to be right now.
I
And I know
love
I just talked a whole lot right there, but
that. I was going to say that right there is just fantastic. I mean, it's a great summary, and I love how you sort of evolved the acronym SRI to, I think
yeah,
we said sustainable, resilient, innovative. I love that sort of
yeah.
adaptation of SRI. You made a comment in the book, and I forget who you had quoted, but what do they call ESG investing in Europe? They call it investing, right? And I
Right.
love that. And it is, and I'm very curious to hear your impressions of how the sort of general approach to socially responsible investing has evolved in the time that you've been in the industry. But
Yeah.
first, if I could ask, I mean, one of the challenges I've sort of felt as I've been in the industry since 2000 was this perceived conflict between, I guess I would say, between passion and performance, right?
Hmm.
You're passionate about these social issues. So many people would agree with, yes, we would love for things to be more sustainable and resilient, but at the same time, I want to grow this portfolio as well as I can. So
Yep.
how do you deal in your own approach? And we'll get to specific thoughts maybe later about the current market environment, but how do you, I guess, help your clients address that potential conflict between companies that do well and stocks that do well? And is
Right.
that a conflict that you run into?
I don't run into it as a conflict at all,
Yeah.
because the way I look at it is we are doing what is the definition of growth investing, because we're investing in
Mm.
where the economy is going. Um, the only time that we ever run into any conflicts is when we get into a value cycle, like we might have gotten into 21 and 22.
Sure.
So our portfolios are always going to skew over to the growth side. So when we run into value cycles, we will typically underperform. But and I can't get into specifics for compliance reasons, but Morgan Stanley just came out with a report within the last month that is basically looking at global ESG funds, and they showed that globally ESG funds were either competitive or outperforming over the
Hmm.
periods that they were measuring them. And I'll share that report with you so you can share it in the podcast notes here.
Sure.
But the studies consistently show, and I'll never say that we're going to outperform. I'll always say that we're going to be competitive with
Yeah.
traditional benchmarks. But I think the opportunity lies not in the short termism of am I outperforming for this quarter or the next quarter, but I think the opportunity lies in the fact that we're really investing in where the market's going. We're investing where the economy is going, and so again, I think that sort of precedes a long-term growth trend.
Oh, that's really well said, and I appreciate your comments there. I mean, and you're right. It is probably cyclical in many ways, and we happen to be sitting in one of those periods where it's been tough to be a value oriented investor. So the good news is
Yeah,
the sort of
yeah.
market cycles have sort of supported what you've been doing for sure. Let's talk a little bit about just the process of evaluating companies based on
Mhm.
these different metrics. And you launched Krull and Company 2004, I believe, right?
Yep. Yep.
Now we're recording this in 2025. Can you talk about what it was like, right, as you're getting started? How were you? What did you do to evaluate companies and try to evaluate them according to some
Yeah.
of these metrics? And how would you compare that to what you're able to do now, sort of data process wise?
Well, back in the day, I was only using mutual funds. It wasn't
Right.
feasible
Yeah.
from multiple perspectives to actually go into the individual stock realm. Partly
Mm.
because there wasn't a lot out there to buy that we have right now. So that's one of the biggest changes is that I've got a much bigger universe than I
Yeah.
had. So, for example, our Green Sage sustainability portfolio I've been managing since 2012. That's the individual stock portfolio.
Yep.
And I remember our first universe of stocks that I drew from for that portfolio was about 300, 350 stocks, give or take, which, back 12 years ago or 13 years ago was pretty good. Right now it's in the neighborhood of 750.
Wow.
And the way that I sort of create that universe is really trying to look in my crystal ball and see what are the industries that are going to help make us more sustainable, resilient, and innovative. And in doing so, it's some of it's the low hanging fruit, clean energy, batteries, transportation, things like that. But if you're going to have a well-rounded portfolio, as you know, you can't just be completely thematic where you're just focusing on a particular area. And
Yeah.
so, the only sector that we don't include in that portfolio is the energy sector, which is fossil fuels. We
Sure.
don't want to invest in the sector that is the cause of what we're trying to create, or invest in the solution for.
Yeah.
And one important thing to keep in mind is that when you invest in the energy sector, it does not include solar, it does not include wind, it does not include geothermal or anything like that,
Right.
or batteries. The energy sector is only fossil fuels. Uh, if you want to invest in solar, a lot of times that falls under tech. If you want to invest in wind, a lot of times that falls under industrials, as
Yep.
do batteries, either tech or industrials, or basic materials as well. If you're going to invest in lithium or some of the other minerals that go into there, and so when I'm some of the other areas that we typically will invest in is real estate.
Mm.
So many REITs have transitioned their
Sure.
buildings from traditional buildings to LEED certified buildings, because they recognize that the investment that they make up front in better insulation, better water management, solar, and things like that, pays off tremendously down the line in that investment. Another area that I think is important too is biotechnology, and I don't
Mm.
mean big pharma. I mean actual cutting edge biotechnology, because a healthier society is going to be a more sustainable society long run. And
Mm.
so, using cutting edge technologies like, say, CRISPR-Cas9 or mRNA, or even now a lot of not a lot, there's a couple companies that are starting to use AI in their drug discovery, which I think is a huge opportunity to both, have the amount of time it takes to bring drugs to market, and also have the amount of money it takes to bring them to market. And I think, if there's a lot of debate about AI right now, the amount of energy it's using, water, and things like that. When we're using it for a purpose such as drug discovery and biotechnology, I
Mm.
think that the opportunity there really fits into a sustainable or a socially responsible kind of portfolio.
You had mentioned it's super helpful, Pete. You had mentioned in your book this concept of greenwashing, right? And I guess
Yeah.
just sort of implying how much you can trust what companies are saying about what they're doing. And it reminds
Yeah.
me, when you describe it, it reminds me a lot of sort of the AI euphoria that's come out. All of a sudden, every company's talking about how central AI is to everything that they do, right? Regardless
Yep.
of what their business is. And I think you could assume maybe in some way that there's a similar drive for companies to to sort of appear as more environmentally
Yeah.
friendly or more socially responsible. How much of that plays into in your opinion, your ability to really evaluate these companies? Is that a real issue, or is that more of a false challenge that probably may be overplayed?
It depends what you're doing. If you're
Okay.
doing ESG investing, where you're just applying a screen over top of an index,
Yeah.
greenwashing is really important to take a look at. If you're doing it from a sustainable ground up perspective, where you are specifically targeting sectors and industries that are actually adding to the next economy, it's less of an issue. But it's interesting. I think since I wrote the book, we've had a transition in administration, and one of the things that we've seen is another term called green hushing, which is which I want to address greenwashing, but I also wanted to bring this green hushing idea to the
Yeah.
forefront as well, because what you find is there's certainly a lot of pressure on companies to get rid of their DEI policies, and obviously scale back sustainability initiatives and things like that. But companies know deep down, because of the research they've done and their experience, that having diverse workforces is really, really important, and actually potentially affects the bottom line. And having sustainability initiatives also makes for a better company, having diversity in the boardroom, in the C-suite, different things like that. And
Yeah.
so they may not be putting press releases out about, hey, look what we've done now, but they're continuing on carrying on those processes, carrying on those initiatives, and just simply not talking about it. So that's called green hushing.
Right.
Where I find greenwashing is more prevalent is specifically in the mutual funds and ETFs. And you can put just about any kind of name on a fund, right? The climate friendly fund, or Sue's low carbon fund. But until you actually lift up the hood
Oh,
and take a look at what the holdings are, you
yeah.
really don't know what you're investing in. And the thing that I've learned over the years is that retail investors, when they go to an advisor and they say, I want to invest sustainably, they don't want the less bad ESG version. They want the bottom up solutions based version. And so if you buy them the BlackRock ESG Aware Fund, which is, it's a big fund. It's a $13 billion fund. It's got low fees, but you're also going to own ExxonMobil in it. You're going to own McDonald's. You're going to own FanDuel. You're going to own all these things that, if you buy that for a client and they come back to you and they're like, yeah, do you
Hold
remember that
on.
time I asked you to buy me a sustainable portfolio? What were you thinking when you bought this?
Uh,
That is really where greenwashing, in my opinion, is really sort of in our face. And so,
yeah.
there are something on the order of 500, give or take, different ESG, sustainable, carbon friendly, whatever the hell you want to call it, mutual funds and ETFs out there. But the reality is very few of those we would actually be comfortable holding, partly because most of
Mm,
them, or a good portion of them, have fossil fuels in them,
yeah.
and most of them really aren't starting from the ground up. They're more the top down, less bad kind of funds.
Yeah, and that is a well-trodden path, I feel like, in the financial industry, right? Sort of starting with an index, a well-known, well-defined index, and just
Yep,
trying to like rebalance it, tweak it, and then
yep.
throw a nice wrapper on it, throw a nice title, and see if that can garner some assets, right?
Well, and they design those in many ways for institutional investors because they design
Yeah,
those to reduce tracking error, right?
yeah,
And you you can't really index where the economy is going by looking in the rearview mirror. And what most indexes are is where the economy was yesterday, not necessarily where the economy is going to be tomorrow. And
yeah,
so the idea that you're just going to take an off the shelf index, tweak it a little bit based on ESG risk is fine if you're comfortable with just reducing your risk a little bit. But if, again, as I said, most retail investors actually prefer to own the solutions providers, you're going to find very few solutions providers in those portfolios, or at least they're not going to be the higher allocation percentages.
yeah. No, really good point there, Pete. So some of the listeners on our show are financial advisors or wealth managers that are trying to provide sustainable solutions for their own clients. How would you, I guess, what you're describing with issues like greenwashing, with issues of like how do you really understand what a company is doing and just what they're putting out there? I feel like the due diligence process ideally would be one by one going through these companies and really trying to understand what they're doing. But obviously, it's much easier to use some sort of model or some sort of
Yeah.
data source that does that. Are there data sources out there that you found helpful to actually that actually map pretty well to those sort of long-term sustainable goals that you think are important?
That that's part of the problem
Yeah,
with ESG right now is that there is no standard. There
yeah,
is, the transparency is lacking. And so if you're trying to build one from the ground up, unless you're dedicating a lot of time and energy and resource into it like we do, then your best bet is probably to outsource it. I mean,
yeah,
that's just the bottom line. Unless you really want to say, you know what, we are going to transition our firm over to be a sustainable firm, and that's all we're going to do for clients. Is better
yeah,
to outsource it. Now, I will say that Morgan Stanley does a good job at putting reports out on the state of the ESG and sustainable investing market. And their last report that came out, I think January, February, give or take, of this year, said that 99% of Gen Z 97% of millennials and 86% of Gen X are either somewhat or very interested in sustainable investing. And
Wow.
so when you consider those numbers, this is not just a niche, this is actually a generational shift. And so
Yeah.
we already know that about 70% of next gen will leave their parents or their grandparents' advisor when they get that inheritance. Unless you have a sustainable investing solution, that 70% is going to kick up even higher.
Yeah.
So this
Yeah.
is actually a great opportunity for advisors to start retooling as that, the great wealth transfer, which I'm pretty sure it's already started, but everybody always puts it off a decade or so, but that's been in perpetuity, it seems like. Um, but this is a good opportunity for advisors to be thinking, okay, what does this next gen want and what is important to them?
Mm.
And if you don't have a solution, you have a good chance of losing that next generation. And so if you want to perpetuate your business, get to know this, team up with somebody like Earth Equity or something to be able to actually provide those solutions that these next generations are asking for.
Yeah, thanks so much for addressing that generational difference because I 100% would agree with that. I'm a Gen Xer, and you can see how things evolve from one generation to the next. It's hard to imagine that this won't become more and more important to a larger and larger cohort of the investing community. If we could,
I'm proud Gen X as well, so we're in the same boat here.
we're representing here, Pete.
Yes,
So
we are.
let's transition a bit if we could talk about the current environment, sort of the future
Yeah.
of sustainable investing and where you're seeing some opportunities here. I'd love to start because as you mentioned, I mean, very few I think have done the work that you and the team at Earth Equity Advisors have done to really understand the space and think about where the opportunities are going to be.
Yeah.
We have an issue, as I'm sure you're painfully aware, in the US benchmarks of being incredibly top heavy. So
Oh,
if you
yeah.
buy the S&P or the Nasdaq, you're buying a small subset of huge names.
Yep.
How would you evaluate? I mean, how well do those companies that are now becoming the benchmark for so many? How well do the Microsoft, Apple, Meta, Alphabet, Tesla types of names score along these lines? I mean, should we be optimistic about the largest companies and the footprint that they're leaving, I guess, for the future?
That is a great question. We do not have much of the big ones in there. We do have NVIDIA
Okay.
that we invest in.
Okay.
Uh, uh, I'm of the opinion that the opportunity for good to come out of AI is probably greater than the opportunity for bad.
Mm,
Um, I could be wrong on that, but I think that the opportunity is definitely there. Um, of course, the problem is energy. The problem is water. It's a resource issue with any kind of technology. All those names that you mentioned are all investing billions and billions and billions of dollars in AI, and so. Um, that it's been dictated to us that that is where the future of technology is,
yeah.
period. And so it's sort of Star Trek-esque, resistance is futile, right? And so how do we, we're the Borg, right? But how do we work within that paradigm?
Yeah.
And from my perspective, it is obviously really hard when you look at from a performance basis to compete with those top 10 names, because what do they take up, 30% of the S&P or something ridiculous
Yeah.
like
That's
that?
right. That's right.
Um, but ultimately, so well, you asked about where we are right now, and you would think that based on the administration that we would be running into tons of headwinds
Right.
in sustainable investing in solar, whatever it is. But when I look at the first Trump administration, the energy transition actually outperformed what it did during the Biden administration. And now that
Wow.
we've flipped again, it's outperforming again based on one of the funds that we use.
Right.
And so if you're trying, and you and I both know this when it comes to the market, if you're trying to predict what the hell it's going to do, you're going to be wrong majority of the time. And so ultimately, what this comes down to is create your structure of how you're going to put portfolios together, tweak
Mm,
them a little bit as necessary, but don't assume that just because somebody, you know, who resides in the White House is going to change things materially. Um, we're not necessarily seeing that in the bottom line with investments.
hmm.
Um, And so the way I structure our fund portfolios is I will use a core sort of modern portfolio theory, large, mid, small, international, emerging markets, and
Sure.
I'll use the best ESG funds that I can for that. Um, but I complement those with thematics, and I think that's really where, from a sustainable side, that's where the difference gets made. So we complement that with energy transition, with
Mm,
infrastructure, with water, with real estate, and with biotechnology. Those are themes that I think really are the next economy thematics going forward. Now that may change next year. There
mm.
might be something else that we put in there as a theme. But right now, those are the five that I think from a sustainability perspective make the most sense. So I can have a good core and then complement it with these thematics. And I mentioned infrastructure earlier. I think that infrastructure is a huge opportunity, and if you're not viewing it, depending on the level of investment, you can get into a lot of really good private investments on infrastructure, but you can also find some that are on a bunch of good ones on the public side as well.
Yeah. Oh, I'm so glad you addressed that because I was going to ask you, Pete, about just I mean, obviously, we've gone through a couple changes in administration, and generally, from an administration perceived as very unfriendly to green energy sustainability to one incredibly open to that, and
Yeah.
there and back again. It's and again, I mean, is it one of those things where the fear of the unknown, the fear of what may happen, just outweighs the reality of how that's going on, or are there specific, I guess, decisions or policy decisions that have made it not as bad as I think many perceive? Because the expectation going into a year like this is, all right, that's the end
Mhm.
of green energy. These things have got. I mean, these stocks are going to be crushed
Yep.
by the XLE and go to bed. I mean, energy's probably been one of the worst trades in 2025, arguably. So, I mean, is it just
That's because
is
we've
it just
overbuilt, right?
yeah? Is
We've
it
we've
is it a gap
overpumped.
between expectations and reality? I mean, what causes that disconnect? You suppose?
It's simple economics,
Yeah.
because what's happened is the cost of clean energy has
Yeah.
continued to drop, even um, without any added government money, without
Right.
any initiatives.
Right.
And in 2024, 96% of all new generation in the US was either solar, wind, or batteries.
Wow.
96%.
Wow.
And the projections for 2025 is that it's going to be a little bit less, but it's still going to be above 90%. And the reason that is because it's cheaper to build cleaner.
Right.
And anytime you're dealing with fossil fuel based energy, it's always going to be at the whims of whatever the commodity prices are.
Sure.
And that's the same thing with the price of energy stocks. Price of energy stocks don't necessarily trade on fundamentals. They many times trade just simply on what's the price of oil, natural gas,
Crude
or
oil.
coal.
Yep.
Right, exactly. And so that's why when you look at the energy sector over any long term, the only real gains you get off of that is going to be off dividends. It's not necessarily going to be on pure growth.
Oh, that's so well said, and I appreciate you addressing some of those nuances. And again, I mean, I since meeting you, I've been completely interested in sustainable investing, and probably some of our conversations led to that interest. I've been surprised at what I've read that explains how much less expensive clean energy ends up being,
Yeah.
and I feel like that narrative did not get into my head before I really looked into it. Can you talk a little bit about other asset classes? Right, how do you apply sustainable
Mhm.
investing approaches to things like bonds, to things like gold, precious metals.
Yep.
You'd mentioned REITs. I mean, how does that inform or impact your decision in other asset classes as well?
We use mostly funds on the fixed
Okay.
income side, so I outsource most of that. Calvert, for a long time, has been a strong mutual fund. When it comes to fixed income, we use mostly mutual funds, and
Mm,
the reason we use mostly mutual funds is it's hard enough, I think, trying to gauge the equity side.
yeah.
Fixed income, I think, is even harder. And
Mm,
so we've used Calvert for a number of years for most of our
okay.
funds. They've got a couple funds that are core to our fund portfolios. Doesn't mean that we don't buy individual bonds. There's a firm that we have on the equity that we own on the equity side that has recently floated some bonds that we've been able to get on Fidelity, and they are, it's a sustainable infrastructure company, and so it's
Mm.
really exciting to be able to put that into client accounts. But on the bond side, there were these green bonds that have come out over the years that are intended to go towards sustainable projects. The problem sometimes with those is a lot of the fossil fuel companies will float green bonds to sort of green up their operations, and so that sort of confuses clients. That confuses, I think, the market in general. You're like, well, why am I buying an ExxonMobil bond in my green bond portfolio? It doesn't make any sense. Well, it sort of doesn't, but it sort of does at the same time if they actually are using those, and if they actually is a third party that is monitoring where the proceeds of those bond raises go to.
Mm.
Um, Real estate. Real estate, I think, is again, we use typically an outside manager, but we do have real estate equities in our individual stock fund. But to me, that's a no-brainer because 30% of our emissions come from the built environment. So any kind of traction that we can make in terms of reducing our energy usage, our water usage, even just the health of buildings is an opportunity. And I think that there was a study done by it's either CBRE or JLL, I can't remember, one of the big real estate companies, saying that LEED certified buildings actually rent for higher rents because people want to be in those more energy efficient and healthier buildings.
Oh, very, very interesting. So, congrats, Pete, again on the upcoming book, The Sustainable Investor, and we'll put a link so people can get info on the book and the pre-order, which is available. What do you hope that retail investors, picking this up, what do you hope they take away from The Sustainable Investor?
My hope for both retail investors and for financial advisors that pick it up is that they really understand what sustainable investing is all about, that
Yeah.
it moves beyond not just the misinformation that's out there about what we do, but the actual intentional disinformation that is put out there. Because there's a lot of disinformation that goes out simply because fossil fuel companies aren't making the transition fast enough, and so they don't want investors to divest from their stock or whatever it is. And it's we as a sustainable investing industry need to be just as loud putting out information as the people who are putting out disinformation are. And that's something that I've talked with the head of our of the Sustainable Investment Forum, which is our trade group, is we
Right.
need to be putting out just as much positive information as negative information is out there. And so that's really what I hope for the book. Obviously, I want people to learn a little bit. I want them to be able to transition their books of business or their individual investments. And if they don't want to do it themselves, I'm hoping that they'll come to us and let us help them.
Pete, this was awesome. I feel like we just scratched the surface about
Yeah.
sustainable investing, about ESG, but I hope we can continue the conversation another time. But for now, I will say thanks so much. Congrats again on the book. Congrats on your successes with Earth Equity Advisors. And we'll keep in touch. All right.
Thank you, David. It has been an absolute pleasure.
We'll put a link to the upcoming book from Peter Krull called The Sustainable Investor. Really, again, I enjoyed reviewing it in preparation for this discussion and really enjoyed asking Peter some of the questions that I came up with after reading his new book. I really appreciate, I think one of the main takeaways I have is, totally resonated with me was this idea of, sort of grading companies and sectors and industries based on their like historical report card. And what you have to remember is, really the future of sustainable investing. It's really about looking forward. It's looking for where those opportunities will come down the road, right? Months, quarters, years, even decades down the road. And I really love that forward-looking perspective when you're thinking about socially responsible investing. Really appreciated his comments about the relationship between passion and purpose, right? Finding companies that are in line with your values, if that's something that's of interest to you, but also relating that back to performance. And he had some great data that he was able to share with me about some of the performance in some of these particular thematic plays and how well they've done. Really appreciated his comments about AI as well. He got ahead of some of the questions I was hoping to answer about AI and what that means for the future of ESG, future of sustainable investing. I really love his perspective there as well. Thanks again to Peter Krull joining me from North Carolina today, sharing some great perspective. And again, congrats on the new book, The Sustainable Investor. That'll do it for today's episode. By the way, if you want to learn more about how we analyze companies using the best practices of technical analysis and behavioral finance, how you can align your values and what's important to you with the actual evidence the markets provide back to us in terms of performance data and technical indicators, our Market Misbehavior Premium memberships may be a great opportunity for you to upgrade your own decision making in the months to come. 3 great benefits of our premium membership. Number 1, we will teach you all you need to know about technical analysis and behavioral finance through our virtual courses, which you can access on demand at your own pace. Second, our members-only reports, like our weekly flight plan, where every week we reflect on what we learned in the week that just happened. We look forward at the week to come, looking for opportunities, what levels, patterns, signals we're on the lookout for. Also, our monthly chart review, where we apply our proprietary market trend model to a series of ETFs and asset classes. Finally, you'll have full and immediate access to our members-only community, where you can ask questions, you can learn from other premium members, and get my own insights as I'm in there every day sharing ideas and answering questions from all of our premium members. For more information on our premium memberships, go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. Again, I'm Dave Keller with Market Misbehavior. Thanks so much for joining us on the show today. And remember, it's always a good time to own good charts.